Right, everybody, welcome to this morning's webinar. Before I hand over to Chris to kick off the session, I just want to let you know that we are recording it. So if you'd like to rewatch it, the video will be circulated early next week. We're also going to encourage you guys to ask lots of questions. There's a Q&A box at the bottom of the screen, so please do pop your questions in there throughout the session, and Chris is going to sort of facilitate a bit of a Q&A later on. Any questions that don't get answered, we will sort of follow up with you, so yeah, do sort of pop them in there. And also, we're going to put a few polls out through the session, so please do vote in those. They're anonymous, so you know, share your thoughts, and it'll be great to discuss those with the panel. Right, Chris, over to you.
Good morning, everybody. Thank you for joining us. I see we've got a long list of people who are down to attend, and also some familiar names, so it's good to see so many people joining us. My name is Chris Freeston. I'm head of the banking and finance team at Freeths. I'm also managing partner in the Nottingham office. We thought we'd arrange this session today and get a few of our team together, who I'll introduce shortly, really because obviously it's been a remarkable last 6 months, but we're perhaps now at a stage where businesses have reacted to the immediate challenges, got through the first few weeks and now months, and now it's a time to look forward and reassess. We're getting to a point now with the end of furlough, the returning to the office, children returning to school, which I know is a huge relief for a lot of people, changes to how office working is going to be going forward, the government removal of C bills, CL bills, and other government finance support through banks, and also fundamentally, inevitably, there's going to be some significant changes to the economy, the structure of the economy going forward. And on top of all of that, we've also got Brexit, which almost seems to be forgotten, and a US election. So even without COVID, it would be interesting times, but it really is a remarkable process and period that we're going through. And now really, our view is it's a time to take a step back and assess and look at the opportunities this throws up, as well as the challenges. So to that end, we've brought together a panel of team from Freeths to talk about a few of the world as we see it, shall we say. So we've got Nigel Bolton, who's a partner in our pensions practice, who's going to be talking about how you can use the company pensions to aid with liquidity for a business. Fiona Powell from our employment team is going to be talking about HR issues, retaining talent and reducing risk where there is a need to lose individuals, unfortunately. Sarah Moore from our corporate team is going to be talking about acquisitions and disposals in a fractious market, and also how she's currently seeing market conditions. And also Oliver Jackson from our Restructuring Insolvency team, who's going to be talking about restructuring as a tool for growth. So firstly, I was going to kick off and talking about the banking and finance market and how we see things. But before we do so, we thought it'd be useful to just run a brief poll, which, as Rebecca said at the outset, you can vote in, it's interactive, but your votes are anonymous. And really to gauge how you as an audience see the economy and how it's likely to recover. So if we could get that poll up on screen, question we're asking you all is, how quickly do you believe the economy will recover from this point? Do you believe it will be a V-shaped recovery within 12 months, 12 to 24 months, more in the 2 to 3 year period, or much longer, going beyond 3 years? So I'll just give you all a moment to vote. I think there's just a few more people to vote if they so wish, but I think we're there now. So we share those results. You should be able to see those now. That's probably broadly what we're hearing from clients as well. If anything, perhaps maybe that's the nature of being lawyers. We're perhaps maybe talking between ourselves and seeing it potentially being 3 months or more, 3 years or more. Perhaps no great surprise now that nobody's expecting a V-shaped recovery and a broad spread between 12 to 24, the 2 to 3 year period, a slightly smaller group going for 3 years and beyond. So hopefully, in some ways, I take encouragement from that not everybody is going with the believing that it will be 3 years or longer. So that is interesting to see. So there's the results there, which you should all be able to see. And then in terms of the banking market, really, in many ways, we're fortunate. I can't believe we'd ever be saying this. We're fortunate in some ways we had the global financial crisis of 2008, because although clearly that was a very difficult period, at least at that point, the banking market and the regulators as a whole took an opportunity to improve the regulation and capital adequacy of banks and clearing banks. Without that, there is every chance now that the current crisis would have been far worse. As has been well publicised, the balance sheets of the banks is far stronger than it has been as a result of the changes since the global financial crisis. And we're certainly finding that means that banks, particularly the clearing banks and the main lenders, are much better placed to deal with the current crisis and the current situation, and therefore have been able to be used as a tool through which the government loan schemes, the C-bills, the larger C-bills, the CL bills or kill bills, as some people have talked about them, and also the smaller bounce back loans have been used through those lenders. The other positive that came out of the global financial crisis was, in terms of the banking market, was a change to the demographic of the banking market. Prior to that date, it had been very much dominated by a number of large clearing banks. Since that time, it's been an opportunity for the UK banking market to perhaps change to reflect more the banking and finance market you saw previously in the US, with a lot of non-bank lenders and challenger banks entering the market who are more dynamic and able to give a wider spread of opportunities and appetite for loans and different types of risk. And certainly, as this current situation's developed, that's meant that there's been a more stable and agile banking market for corporate clients, businesses to use and take advantage of. As we said at the outset, we're now at a period of change. We're coming to the end. We're beginning to come out the other side, whatever shape that might take. The government loan schemes are being withdrawn. Credit approvals need to be given by the end of September broadly for most of them. And we have seen since August a significant reduction in requests and transactions we're acting on involving C-bills and CL bills. And I think that will continue to reduce. And really, it's been a period, as with all businesses, it's been a period while lenders have taken stock. Going forward, in terms of what we're seeing, where we're seeing appetite from lenders, it's really been, particularly in the real estate finance market, it's been a case of sheds and beds, which I think a lot of you will have heard as a phrase that's been used. So care, student to an extent, residential and industrial. There's been a lack of appetite for other sectors in the real estate market, and I think, speaking to lenders, that's likely to continue to be the case for quite some time. In terms of corporate lending, we've not seen a huge amount. Speaking to clients, intermediaries and the like, that's been what we're hearing elsewhere. There have been lenders being active in managing their existing client portfolio, and they've been active in lending through C-bills and similar, but there's not been a huge amount outside of that, and banks are now looking to assess how to take that forward. I think it's fair to say that particularly the large clearing banks are looking at managing, as I say, their existing loan book, and in some ways are reskilling or reconstituting teams. So they're putting a greater focus on managing existing debt rather than looking for new loans. As I said at the outset, that perhaps creates greater opportunity for the funds and the non-bank lenders. So it's going to be interesting to see how that dynamic plays out over the coming weeks and months. And inevitably there will be a bit of a scramble perhaps from some of the challenger banks who we do a lot of work with to try and take market share from clearing banks who are perhaps retrenching and perhaps just taking a holding pattern for the moment. Talked about the regulatory position and how the global financial crisis has enabled lenders to be better placed, better used to support the corporate market and the economy as a whole. The slight downside for that is, as inevitably some loans do go bad and lenders need to start make provision for potential bad debts, because they need to make greater provision than was the case previously, this is going to result in there being less able to lend capital or have capital available to lend. So I do expect to see a tightening of capital unless there's greater government support. And I suppose that is the big question. We really don't know how that will play out. There is already talk and some lobbying to the government to extend the CBILS. It'll be interesting to see if that takes place, but I do expect to see some tightening, particularly amongst the clearing banks, as the capital adequacy rules begin to really take hold and reduce the amount of capital they'll have available to lend as they're making provision for more doubtful debts. The non-bank lenders don't have those same risks or issues, but having said that, they often have a greater need to repay funds to their investors. So it's likely that while we may see, particularly under government pressure, the clearing banks being more patient with defaulting lenders, the non-bank lenders being less patient and more inclined to enforce. And we are beginning to see that happen already. We're beginning to see it's not much more than a trickle, but we're beginning to see enforcements taking place and lenders taking action. But it does tend to be the smaller lenders, challenger banks or non-bank lenders that are doing that at the moment. The clearing banks are very much staying clear of that for the moment, largely because of political pressure, and also they don't have the same rush and often don't have the same risk profile. So it's a very fluid market. It's going to be interesting to see how things play out, but I think our expectation is a tightening of credit with the large banks, the smaller lenders, the non-bank lenders perhaps being less patient with defaulting loans, but equally they will hopefully, and it's expected, they will step into the breach and perhaps be filling a lot of the opportunities to lend where clearing banks aren't perhaps willing to do so, as we begin to move forward and get a bit more clarity on where the opportunities are. And I fully expect as we come out the end of this, to actually see the non-bank lenders and the smaller challenger banks taking up an even greater proportion of the banking market than they do currently, and certainly far more than they did 10 years ago or so. So perhaps to end, and before we move on to Nigel, just one more quick poll. Along those same lines, it would be interesting to know if people believe that their bank or banks will continue to be supportive during the current climate. And that's the case whether you see opportunities and are looking to borrow to take advantage of those opportunities, or whether you see the current markets being challenging and are hoping that banks will be more accommodating than perhaps they sometimes are. So we'll just let those votes come through. Just give that a little bit longer. I think there's about another 10 or so people to vote. Fine, I think that's probably everyone who's going to vote. So I think you should be able to all see that now. And that's encouraging, actually, to see that. I probably broadly to expect, but it's encouraging to see that 70% of you are expecting those lenders to be supportive. As I say, certainly with the larger clearing banks, we're expecting that to be the case. That's very encouraging to see that. That's so. So I'll hand over now to Nigel, who's going to talk about pensions and how you can use the corporate pension to assist your business.
Thanks, Chris. So for once, I'm not going to talk about final salary schemes and deficits and how damaging they can be for their sponsoring employers. I've got a positive story from pensions, and this is about a certain type of scheme, a small self-administered scheme, or SAS, used a lot by directors and family business owners, SMEs, small family businesses. And they can, at the current point in time, they can be a really useful way to inject short-term liquidity, cash flow into a business if they're used properly. So what is a SAS? SAS is a fairly unique type of pension scheme. It is generally, its main investment type is property, usually the factory site or the office site for the sponsoring employer. It can use the property to raise loans. It can make loans itself to its sponsoring employer. Making that loan to the sponsoring employer is the way that the SAS can be used to inject money, cash, back into the business to help it with short-term cash and liquidity issues. The ability to make a loan is subject to HMRC requirements, and there's quite a lot of those, and so any so-called loan-backed being used by a SaaS has to be put in place with some careful planning around it. It's not something you can just rush into. The starting point really is to look at this as a commercial transaction. So from a SaaS point of view, the SaaS can't lend more than 50% of the SaaS net assets. The loan has to be for a term less than 5 years. The interest rate has to be at 1% above the average base rate, which at the moment is going to be around 1.1% in total. So it's a fairly cheap source of liquidity being injected into a business. The repayment terms must be on a capital and interest basis, with at least one annual payment a year, if not more, and those payments should be set out and scheduled. And the SaaS should have first ranking security on a suitable asset within the business. Now, if the business is relying on other sources of finance, this is obviously going to cause a practical issue, because other finance providers may also want that first charge on appropriate assets. But if at the moment there is free assets within the business, this is a nice, easy way to put that finance in there. There are a few other issues that HMRC insist on. The property that it uses as the security has to be commercial, not residential. It has to have a proper valuation undertaken by a chartered surveyor. There will need to be an environmental review. Obviously, the sponsoring employer will want to continue to occupy the business and trade from that business during the intervening period. There'll need to be a full arm's length commercial lease put in place. And really, the reason why it's fantastically important to get all of this right is if it goes wrong, and for whatever reason, either the setup is incorrect or, and it's worth stressing this, in the short to medium term, that up to 5 year term, the company fails to make the required repayments, then HMRC would look at undoing it all and may look at introducing a penalty, which could be up to 80% of the value of the investment in terms of the SaaS lending. So not only would a business and an owner see that the business in financial difficulty, but they may also see a significant hit to their pension saving, which would otherwise be safe. So ensuring that you're looking at SaaS lending, SaaS loan backs as a short-term way to put into what has to be a working business model. It's not really of use for a failing business model. All you're going to do there is inject cash in and imperil your pension arrangement, not enhance your business opportunity. Aside from the SaaS, there are a couple of other things that could be considered out there. I'll touch on these very lightly. SaaSes can also invest in shares, can take up to 5% of the sponsoring employer's shares. Not every business has SaaSes. Some have SIPs, self-invested personal pensions. They can also invest in commercial property, but they can't make loans to the business, so the loan back opportunity isn't there. Nor can they invest in shares directly in the business, because there's potential issues there with taxable movable property, where the business owner is a connected person. So, as I say, there are opportunities out there at the moment which give something different if a small business or a family business has that SaaS in place and has the time and space to think about this ahead of any sort of really calamitous cash flow management issue. And that's really all I'm going to touch on to start with. I'm going to hand over to Fiona now, who's going to talk about opportunities in the future with HR.
Yes, thank you. So we all know the huge impact the pandemic has had on the workforce, and lots of employers are unfortunately having to consider redundancies, changing terms and conditions, and will have furloughed staff. And in terms of furlough, that scheme is coming to an end in October. From the end of October, we've seen employer contributions have increased steadily from August, September, and then into the last month. And there is pressure on Rishi Sunak to extend that. We've seen a lot of European countries, so France, Spain and Germany, are all extending theirs into next year. And I saw my phone pinged earlier with a BBC alert just on this very point, that MPs are putting that pressure on, but at the minute it's not the case that it's going to be extended. There's also the job retention bonus, which is a one-off payment to employers of £1,000 for every employee who was part of that scheme and who remains employed until the 31st of January as well. But obviously there are some sceptics who have questioned whether that will incentivise. And that leads us nicely onto our next poll question. If we could just see that on the screen. So we just wanted your thoughts on that. What do you consider will or has been the trigger for the majority of businesses when considering whether to make redundancies? And yeah, unsurprisingly, with the results coming in, the majority, so it's fluctuating slightly. We've got quite a few coming in. But the majority seem to be going with number 2. So yes, 80%, which isn't at all surprising. The Office for Budget Responsibility has warned that as many as 1.25 million jobs could be lost when the job retention scheme ends. And we also had data through this week which showed that 300,000 jobs were at risk in June and July. So against that background, it's really not surprising that we're seeing lots of employers start thinking about cost savings, particularly in this area. Your workforce are significant, they're a costly asset, but at the same time, they are your most important driver. So there is a degree of future proofing that you need to think about too. And that's where we come on to look at retaining talent. And that's very much sector and need specific. I had a client the other day, they've had a downturn in work, but they've also got a skills shortage. So they just don't want to let go of some of these workers who really contribute. They've got specific skills. And when the market does pick up, they are going to really struggle to then fill their shoes. So how do you manage that? You also need to think about your future needs as a business, because we saw from the last recession that many businesses didn't do that. And then there were shortages in some areas, particularly around leadership. What you don't want to do is you don't want your future productivity growth to be hindered by the fact that you have got lower skilled employees in place, or when you do have to then re-recruit, you've got higher wage costs to determine. So it's an analysis for employers and businesses in terms of looking at the cost, the time, the effort that you put into recruiting, training and retaining staff versus the risk of losing that investment. And there are options to businesses in terms of preserving skills, future-proofing, and also then avoiding the cost of a complex redundancy process, and of course the negative impact that can have on your workforce too. So things like reducing hours, part-time working, flexible working, of course with a commensurate drop in pay and benefits, but that gives you as the employer, it enables you to retain those staff, but you have the flexibility when you get that upturn in the market. If you're wanting to retain certain skills, can you move those people into other areas of the business? It might be that they're lower paid, but again, it allows you to retain them. It allows you to have that flexibility. And the issue is at the minute, of course, employees, we are in a difficult market and they are more inclined, given the climate, to agree to these type of changes, because the alternative, of course, is redundancy, which they will want to avoid. So it's about looking at those alternatives. And there's a whole host, I'm not going to run through all of them, but ways in which you can reduce headcount, reduce maybe pay and benefits, maybe enforce some ways of stopping working for a while. There are other options which don't necessarily go down that redundancy route. But if you are putting in these kind of temporary measures to try and weather the storm, it is or is likely to amount to a change in employees' terms and conditions. So there is a process that you're going to have to go through, plan for that process. And you need to make sure you have a good reason and that you inform and you consult with staff, because it can result in a dismissal and, of course, arising from that, the risk of claim. So plan it, seek advice on it, and bear in mind as well, if it could result in excess of 20 dismissals, there might be collective consultation obligations. And that leads then on to, unfortunately, in some restructuring, it will amount to a redundancy and you are going to have to make redundancies. That's difficult for any business, and where it can't be avoided, again, I think the key to it is planning, making sure you have enough time. Don't leave it till the end of furlough in October. Start thinking about it now, particularly if it's in excess of 20 employees that you're proposing to dismiss. There are legislative timeframes to comply with, depending upon the numbers. And there's also requirements to notify the Secretary of State, to inform and consult with staff. If you don't have a recognised trade union, you may have to elect employee reps. So lots of complexities in the legislation which you need to adhere to. And of course, there is a risk if you don't follow process that you could face unfair dismissal claims and protective awards for failing to inform and consult. So that is my quick summary from an employment perspective. My 3 takeaways from it are: planning is really key, however you're reshaping or restructuring, or if you're making redundancies, you have to plan this process. It's so important. Flexibility, build that in. We all know it's an ever-changing, fluid situation. It doesn't necessarily have to be the short-term gain and cost savings a redundancy can provide. Look at the benefits of other options as well. And that allows you the flexibility to pick up when markets pick up. And the final piece is communication. A client said to me the other day that, during difficult times, employees are going to remember how you as the employer treated them, dealt with them. And we've seen through the pandemic that the businesses that have navigated well through the process have put communication at the fore. Communication, again, is a key provision within those legislative frameworks that I've talked about as well. So do put that at the heart, because I think in times of uncertainty, there can never be enough. It restores confidence in your staff, and in turn that will transfer onto your customers. So I'll now hand over to Sarah.
Thanks, Fiona. So I'm just going to talk a bit about the M&A situation at the minute, and what we anticipate might be coming up in the next few months. So since we went into lockdown in March, deal activity has significantly dropped off. It is not unexpected. Deal volumes for normal M&A trade sales have reduced, and that's likely to continue, so that deal volumes will continue to be suppressed in the coming months as a result of both the pandemic and the ongoing Brexit discussions. This in turn is likely to lead to lower valuations of businesses, and then can potentially lead to some distressed and special situations. In this circumstance, as a buyer, you might therefore be able to snap up a bargain, and as a seller, you might be able to find an opportunity to divest part of your business, so then you can focus on future areas for growth on another section of the business. So when we're talking about distressed M&A, this is a pre-insolvency situation, so there won't be an insolvency practitioner involved. And whilst as a buyer you might be able to get a bargain, an acquisition in this way still needs to ensure that there's a fair price that's not at an undervalue, so there's reduced risk of challenge at a future date. So some key features in a distressed situation: the timeline will be very, very fast. Often it's referred to as accelerated M&A, although worth noting that not all accelerated M&A will be a distressed situation. The buyer is often in a stronger position because it's the seller that's in a distressed position, and therefore that usually means that the buyer is able to drive down the price. The quid pro quo for this is that there's usually limited time for due diligence, and also limited warranty and indemnity protection from the seller. It might be that a seller chooses to go through an auction process for this, selling the business or the shares to the highest bidder based on a pre-prepared set of documents, which are either non-negotiable or only nominal negotiation is permitted to get the deal done in a very quick time frame. If an auction process is used, then it's usually a share sale rather than a business and asset sale, because this removes the need to obtain third-party consents, novation of key contracts, etc. But that does mean that the buyer will take all the risk in the company, including any potential tax or other liabilities that might be within the company. And acquiring the equity carries further risk for the buyer, as the previous transactions and actions of the company could be challenged, particularly if during that time management has succumbed to certain pressures from creditors or acted without proper consideration of contracts or regulations. Ideally, in a normal situation, there'd be time to review all this through a due diligence process and deal with them prior to the acquisition, or seek contractual protections. But given that there is usually a burning platform, there's a significantly reduced timeline, reduced due diligence, and also the seller might just not have sufficient funds to meet any warranty claims. So focus is often, as I've said, on the price and allocating risk through a price reduction. The majority of normal or non-distressed M&A transactions, percentage-wise, are share structures, so you'd acquire the shares and the company. But it is more common for a business and asset sale to be the situation for a distressed situation. This is because whilst I've said that in a share sale it means that you don't have to novate the contracts and everything, in a business and assets acquisition, as a buyer you can cherry pick the assets that you want and leave behind liabilities and not have that sort of tax risk. It's also a case where if there are key contracts but the buyer wants to proceed on a business and assets sale, they could agree deferred consideration or an escrow arrangement until that has been dealt with post-completion. It's worth noting as well that on a business transfer, then TUPE will apply, and it's not uncommon for the buyer to take any risks associated with the employees going forward. And it's also important to check that the business is actually trading as a going concern to ensure that there's no additional VAT risks. As I've said, sellers are maybe unwilling or less willing to provide warranty and indemnity protection in a distress scenario, and also they struggle potentially to stand behind those warranties. So the question could come up as to whether warranty and indemnity insurance is available in these situations. Generally, we've found that it hasn't been, because insurers want to see a full due diligence exercise has been undertaken before providing insurance coverage. But we are expecting to see some insurers now offering some policies in M&A distress scenarios, and we're expecting to see some innovation in that area in the coming months. So that will be interesting to see how that plays out. As I've said, with distress situations, it's not unlikely for there to be deferred consideration or an escrow situation, and also which there for the buyer's protection, but it's also potentially common for the seller to seek some anti-embarrassment provisions, so that if the buyer then snaps it up as a bargain and flips it on elsewhere at a significantly increased price, then they get some they've got recourse to get some funds back if that does happen. So to summarise, we are expecting deal flow to be suppressed over the coming months and opportunities for distressed situations. That may change, you know, in the next couple of months, if we expect to see changes to the CGT rules that I think people are anticipating later on in the year. But I think for the majority of normal trade sales, they are going to be suppressed. And now I'm going to pass on to Ollie, who's going to talk about restructuring.
Thanks, Sarah. Good morning, everybody. So not wanting to end on a pessimistic note, but I'm just going to talk about what will happen if there is no solvent solution, and how to deal with a potentially financially distressed company, either speaking to directors of companies, or where companies are having issues with customers or suppliers who have unfortunately gone into an insolvency process, and looking at options around that, and what opportunities there are, and what things do people have to be aware of when they're looking at financially distressed companies. So, as most of you will be aware, there's been a lot of legislation introduced over the last 6 months that's been intended really to protect companies and directors during the pandemic. Some of those are temporary. So we have the prohibition on serving of statutory demands and presenting winding up petitions, and also the suspension of directors' liability for wrongful trading. Those will come to an end at the end of this month. Some of the other legislative changes are more permanent. So we have a new standalone moratorium, which is a pre-insolvency moratorium of 20 business days that can be extended to give companies protection whilst they look at how they can rescue the business, and that will give them the protection from creditors during that time. There's also a new restructuring plan, which is similar in many ways to a scheme of arrangement. We're still yet to see how that's really going to impact, but it's another restructuring tool that can be used, and that's with us for the foreseeable, and we'll see how that changes the insolvency world. There's also been the introduction of prohibiting the use of termination clauses on an insolvency, and again we're going to see how that will impact on companies, but the idea behind that is to provide again protection for the companies. Unfortunately, not wanting to be the bringer of doom, but it is expected, I suppose, that corporate insolvencies in the UK will rise. The figures have been thrown around. 27% rise has been suggested by some in the latter half of this year. There's also been suggestions that actually there could be a double whammy here, of where companies have been in hibernation, and actually during that time they've been accruing liabilities, whether that's to HMRC or generally. And then we've got the withdrawal of the government support schemes as well. So there is an expectation, certainly in the insolvency world, that we could be hitting a difficult time in the back end of this year and into next year. I suppose interestingly, over the summer, there have been fewer insolvencies, corporate insolvencies, compared to this time last year. I think if you delve into the reasons for that, it's fairly obvious. The job retention scheme, where 9 million people have apparently been on furlough since March. The impact of that is a potential £20 billion cost to the government. So we'll see how that impacts as we go forward. We've also got the Siebel's loan scheme that Chris mentioned that has really helped companies. And the benefit with that, of course, is that for the initial lending of up to 250,000, there's not been a requirement for directors to provide personal guarantees. Some of the other things that have perhaps staved off insolvencies, there's been the introduction of a deferral of VAT and income tax payments. HMRC are being far more forthcoming with allowing time to pay arrangements. There's been business rate relief, small business loan grants, and obviously the Eat Out to Help Out scheme that I never managed to take part in because everywhere was always booked up. Anyway, I'm not bitter about that. So what's expected? So there's going to be, as I say, an increase in insolvencies. So we need to really be planning. The company directors need to be planning around potential impact on if customers, suppliers go into an insolvency process, and what do they do if the company's in financial distress. It's absolutely key here that as with Fiona's kind of comments around employment and redundancies, there really needs to be that early planning. So the earlier that a company can look into potentially negotiating with lenders, looking at interaction and engagement with creditors is absolutely the key. That there needs to be far more kind of focus on looking at counterparties, looking at the solvency, and stress testing who counterparties are, because there's going to be a lot of pressure during this time. I think also, if a company is in financial distress, it's key that the early engagement, but also with insolvency professionals, whether that's insolvency practitioners or insolvency solicitors and advisors, who can really guide a company through the pitfalls to avoid potential personal liability on the directors, to make sure that the pathway is absolutely planned, and potentially using one of these new restructuring tools to avoid an insolvency, or if an insolvency is inevitable, then planning around that, so that there either is protection for the directors, protection for the creditors, and also looking at the opportunities that will come out of that with a potential pre-packaged administration, where the business and assets can be bought through an administration process. And again, engagement and planning with an insolvency practitioner and professionals is absolutely key to that. And not wanting to end on another negative note, I am a happy chap, really. But there is going to be the introduction again of Crown preference. So we thought this had gone away. It was the right thing to do in our rescue culture in the UK to have HMRC ranking with unsecureds. That's now not going to be the case from the 1st of December onwards. It's been decided that we'll put HMRC back up the pecking order above floating charge creditors, so that certain types of debts due to HMRC, so VAT, PAYE, national insurance contributions, will now come out as a preferential creditor and paid out before floating charge holders, before unsecured creditors. So putting some money back, I suppose, to the VAT man, but the impact of that is going to be felt fairly widely. I do feel that lenders are going to be requiring more personal guarantees. They're going to require more fixed charges, because they know that their floating charge is going to be diluted. So there's all of those things. Not that I'm, again, having an attack on the taxman, but HMRC are now focusing on looking at where companies have been falsely claiming for furlough payments, and also looking at the use of the government funds and CBILS, and whether actually that has been used for the company or not. So I think they're going to be very busy, which would mean that unfortunately the insolvency world will be busier and busier. But as we come to some questions, I'm sure I'll be able to shine some more positive notes on insolvency. Over to you, Chris.
Thank you, Ollie. Thank you to all our panelists. This is the section where those of you online get the chance to ask questions of us and talk about things more generally. There are a few questions that have come in already. If any of the rest of you have got any queries, please use the Q&A box at the bottom to type those in, and they will come in. Again, they're anonymous. We're not attributing them to anyone, so you can ask on behalf of Ollie when the help out to ETAT scheme will be reintroduced, so he can take advantage of it, or whatever you may want to ask. There's a couple of HR specific ones for Fiona, but before we go directly onto those, a more generic one, just the panel as a whole. We've been asked where do we as a panel see the opportunities over the next 6 to 12 months. I think that is relevant because clearly there are challenges, but there's a lot of opportunities, and a lot of our clients, to be fair, we as a business often see opportunities coming out of these sort of situations. So I think it's a fair question. So just open that up to the panel as a whole, really.
I think I can jump in there, Chris. And I think from an investment perspective, now might be the time for businesses to consider private equity as an option where they might not have considered that before. And I think as we all were when we started off from the pandemic, PE houses and investors have been focused on sort of managing their existing portfolios and weathering the storm, but they are starting now to look at other investment opportunities. And globally, the private equity industry started 2020 with £1.5 trillion to invest that is still sat there waiting to be invested. So I think that as the impact of the pandemic is still being understood, it is still going to be a time for these kind of investors to look at alternatives to strengthen and diversify their existing portfolios. So obviously there's been a downturn in hospitality and travel, meaning that they might be looking at areas where they didn't previously from a private equity perspective, such as IT, infrastructure, automation, healthcare. And I think that we're expecting them to take a sort of longer view on some of their asset classes. And there's also quite a focus on things like renewables and businesses with an environmental or societal or governance focus. So I think that if you're in those kind of sectors as a business, then now might be the time to think about whether private equity is a good choice for you.
Yeah, I think that's right. I think there's a lot of cash out there. This is not the same as the position in 2008, as far as I can see. We're in a very different scenario. And I was reading something recently about some of the sectors or some of the areas where actually there's been a real upturn, and I was surprised by some of the stats. Things like toys. There's been a real boom in toys because obviously children are generally at home more. Cars, apparently there's more car buying at the moment than there has been. And obviously not many people are traveling abroad in fear that they come back and you then have a 14-day quarantine, or you may not be able to get back. So there's a lot of, staycations, the kind of the British holiday industry and kind of static caravans and things like that, really coming full circle. So potentially opportunities there.
From the pensions point of view, interestingly, we've seen a few final salary schemes with big deficits that have actually been able to buy out in the market due to clever investments, because although most world markets took a hit when coronavirus first arrived in the spring, almost all of them have bounced back. So if you look at all the major stock markets around the world, they're now back at or above the levels they were at the time coronavirus hit. So clever investment gives opportunities there. I think for those businesses that are struggling in the current environment within the UK, smart use of your pension benefits and your employee benefit structures, introducing things like salary sacrifice, which could give you a national insurance saving, means that you might not have to resort to redundancies or more savage cutbacks later on down the line. So thinking smartly and planning, it's the same message that Fiona and Ollie have touched upon. Planning in advance and thinking your way through this rather than having to knee-jerk react to circumstances around you is always a really important part of this.
That's helpful. Thank you, everyone. I think certainly it's about being nimble is what we're seeing. We're seeing clients reposition themselves to where they see the opportunities in their relevant sectors. We're seeing some high-end retail clients who are seeing online sales increase by 300 to 500% during the recent lockdown period. But we've I don't want to go over that too much because we've probably done that question. A couple of HR related questions. So Fiona, I guess these are really aimed for you. First one, are we expect to see employers renegotiate contracts to reduce salaries where staff are going to be permanently working from home?
I certainly think that contracts may well be looked at, and certainly if your workforce are at home base now, it's wise to get a home working policy in place. Whether it leads to a reduction in salaries, I suppose it will depend upon the specific circumstances. If they had, for example, a waiting because they were London based and now they're based at home. But generally speaking, I suppose for a lot of employers, if they're still giving the same level of output, then it may not necessarily lead to a reduction. But I certainly think that employers across the board do need to look at what they're going to be doing. And lots of employers are looking at this now in terms of flexible working, agile working. Everyone's talking about it. And certainly the government are looking at flexible working becoming a more default position. So you do as an employer certainly need to plan. And in terms of going back to the retention of talent point, if you want to retain staff and attract staff, lots of people are liking the life home work balance that they're getting. So it's something that definitely needs to be on your radar, and policies and contracts need to be reviewed in light of it.
I think one thing I had actually is I saw an interesting article saying that people doing effectively the same job were willing to take 8% less pay if they're doing it full time from home rather than in an office or office environment. Clearly that's different when you're comparing someone who's that's different compared to the situation where you're actually asking someone to reduce their salary because they are now working from home.
Yeah, I think it's of all those different things. It's commuting costs versus cost to the employee from working at home, and I suppose it's coming up with a reasonable. I mean, ultimately, you can ask your employees and change terms and conditions if you've got a good business reason and they agree. So you're going to have to come up with something that's reasonable, and that employees are going to think, well, yeah, that's fair enough. But certainly, time is a commodity, and getting rid of that commute is valuable to your employees.
Yeah, and another HR-related question for you, Fiona, is how many firms encourage employees on furlough to look at skilling up when they're unable to work? Because obviously that's something you could do during furlough.
Yeah. I mean, it's a really good question. And there was the government scheme, the free scheme, where you could, there was a whole host of employee skills. I've certainly known of some employees, but I don't really know in terms of how widely it was taken up by people. But it's certainly something that should have been, I think, utilised, because it was a great scheme to enable and training, whether it's through the government scheme or whether it's training that employers did. But we certainly were making our clients aware of it. In terms of something that their staff could do, and it was a way to utilise staff and upskill them during that period.
Thank you. And then Ollie, I suppose probably one for you more is what steps can company directors take if the company is in financial difficulty?
Yeah, so apart from the early engagement that I think I beat the drum about, but it is absolutely key, that early engagement with creditors, with banks, to really work through some potential options, looking at the creditor position, regular board meetings, and really it's a case of being focused on what are the next steps. If a company is in financial difficulty, then at that point a director's duties will shift from looking after the interests of the shareholders to the creditors. And if they don't, if company directors don't take steps to protect the interests of creditors, then they could be criticised, and there could be potential personal liability coming out of that. It's very important that directors avoid entering into any transactions which could involve assets of the company being dispersed or got rid of during this time. Real care in looking at what transactions are being entered into. Is fresh credit being taken on with creditors? And does the company have the ability to repay that? Because if they don't, they shouldn't be taking on the new credit. And there's all of the implications around that, and looking at, look, is there a way out? Is there a solvent option here or not? And if there isn't, then the directors need to be speaking with insolvency practitioners and planning for an insolvency. And the way that is done is very, very important. But proper engagement during that whole process.
Thank you, Ollie. I think probably just one more quick question is just, I suppose this perhaps is for everyone, but maybe more Ollie, is around zombie companies. Someone's written in or messaged in to say that there was a proliferation, a lot of talk about zombie companies during the global financial crisis. Is that likely to be the same situation here? I think for perhaps passing on to Ollie, is I know that I saw again an article talking about, I think it's each year typically something about 7 or 8% of businesses become insolvent. Admittedly, a lot of those are startups, but there's been nothing like that rate of insolvency, and is this likely to be are we going to have the zombie company scenario again, where these companies are limping on for months and possibly years at a time?
Yeah, it's a tricky one, isn't it? Because from my perspective, I kind of expecting that these zombie companies will be dealt with one way or another, but it hasn't really happened yet. And over the past few months, there have been the legislative changes, the government schemes that have allowed such companies to carry on. I don't think there's going to be the enforcement from the banks, as you said, Chris, certainly in the short to medium term. So where is the creditor pressure going to come from? Who knows whether when statutory demands and winding up petitions can be used again, when the schemes have come to an end, whether actually we'll see a whole raft of insolvencies and pressure from creditors on those companies, or whether, you know, these zombie companies that will just limp along. I don't know. I would expect that a lot of people will use this as an opportunity and say, actually, we need to get rid. We need to bring an end to these companies, and let's use COVID as the reason for that, because there is the protection there that there's no wrongful trading actions during this time. So I think, don't know whether that answers your question, but there you go.
No, that's great. Thank you. We're kind of drawing to an end. We've got a few more questions, but I'm conscious of time. So I think what we will do is, where those questions are outstanding, we'll come back to when people have asked the questions individually, pick up on those points with you all, because we do want to deal with them, but we're just very aware that the time is ticking on. So just really, to finish, just like to thank all the panelists for their time and contribution today, and also importantly, thank you all for dialing in and being on the call. And we look forward to hopefully engaging with many of you in the coming weeks. Thank you, everybody.
Yeah, thanks everybody.
Thank you.